Hello, everybody, and thank you for tuning in to the Liberty Report. With me today is Daniel McAdams. Daniel, good to see you this morning.
Good morning, Dr. Paul.
You know, the big news today, which a lot of people are looking at right now, has been what's going on in the stock market. You know, in the last couple of weeks, the market had already been down a couple thousand points. This weekend, all the news was negative for the stock market around the world, and China's in big trouble. And the big anticipation was what would happen, and sure enough, our markets went down another 1,000 points as measured by the Dow, which is, rather significant. But the big question is, what does it mean? Is this a mere correction that just will go away in a day or two, or is this part of a major change in our system? And I tend to think that it's more of that there's a change in the process. The whole problem has been that this was pretty evident in 08 and 09. Matter of fact, it's been evident for a long time. Many of us have anticipated this is the case ever since the year 1971, when we totally went off the gold standard. Now, if you take a look at this chart, this gives us an idea about the stability that the Federal Reserve has given us in the last 100 years. So that's rather erratic. And right now it's still very, very high, compared to what has happened in the past. Take a look at in the early 1920s. That was a big crash, and then also in the 50s and 60s there was a sharp decline. And the most recent sharp decline is 08 and 09, but it rather quickly recovered. But what hasn't recovered is the conditions that generates this. And I think you and I have talked about this before about allowing the correction. Austrian economists generally want corrections to be good and necessary, correct the imbalances. But as you know, there weren't very many corrections made in 08 and 09.
It makes you wonder, if at the end of the day things are back to normal, or people are going to sort of breathe a sigh of relief and say, "Whew, that was a rough morning."
No, I think they should keep asking questions. And if they're a day trader, I would think they're very nervous right now. But you might say, why is it down 1,000, then it recovers 600 or 700, and who knows where it'll end today? But we're not dealing with just market psychology. We're also dealing with something that is pretty well known by people interested in this subject, is the Plunge Protection Team. And I'm sure you've heard about that little organization.
Yeah, could you explain for people that may not be that familiar with?
Well, it's nothing official about the name, the Plunge Protection Team. This is called the President's Working Group on Financial Markets. And you say, well, what is that? Well, it's made up of four units in our government or quasi-government too, that interferes in markets when they get rocky. 87 was the biggest drop in one day, 23% in one day. And our very conservative president, Reagan, made him pretty nervous. And so they thought, well, we need somebody to stabilize these markets. We can't allow these corrections, even though the market may be demanding these corrections. So by executive order, he created the President's Working Group on Financial Markets. But the markets quickly realized what it was. It was just a group that is going to try to regulate markets, and so they called it the Plunge Protection Team. If it goes down too sharply, they so-called can stop it. They may be able to give it a pause. But it's made up of the Treasury Department, it's made up of the Fed and the CFTC, the Commodities Commission, as well as the SEC. So there's a lot of power in there and what they can do. But most likely the Fed is the most powerful, because they can create money out of thin air, and they can loan money and give money and buy anything they want. And I'll bet you any money, and we'll never prove it, they were very active today. But exactly what they did and why. But and there's also, when things go down like this, people will say, well, it's a bargain, and they'll buy it, and they'll see some recoveries like this.
It seemed there were a few pauses. I think I was reading on Zero Hedge, more pauses than there had been and forever, I think.
This means that they can pause or hold off if they go down too sharply. I don't know why that is supposed to be helpful, because what you really want to do is get the correction done. It's sort of like if the doctor said, well, you need this shot, but I'm only going to give you a little bit at a time so you get 10 shots instead of one, you know, and that's what they do. They delay it. So the corrections have a purpose. But what happens is when you have this system, and this graph points it out, that it's totally erratic because the government is interfering with the most important price in market, and that is the price of money, it causes distortions and inflation and these different things. So if they do this and they don't allow the correction, then the market is forcing it. So the market actually wants deflation. When it's out of kilter, when it's artificial, and you don't have a booming economy because of hard work and effort and savings, then it's out of whack. It's a regulated economy. It's the reason socialist economies fail is because they're trying to anticipate, oh, we need more houses. You know, we laugh at the communists because they never knew what to make. And Mises, of course, as early as 1912, predicted that socialism will always fail because of the pricing mechanism. Yet today, we have a world economy based on the fiat dollar and based on the assumption that a few people at the Federal Reserve can tell you how much money supply there should be and what the interest rates should be, and that causes all this distortion in the interest rates. But the market wants to correct it. So it's a tug of war that goes on, and that's part of what we're seeing now is this tug of war. The markets would be much lower without artificial interest rates, and who knows where it would be. Let's say the Plunge Protection Team just disappeared and the Fed disappeared, and you didn't have to put up with these gyrations. Where would we be? Well, of course, people get hysterical. Oh, the Fed is good, and they provide great comfort. And besides, our friend Paul Krugman, you know what he advocates.
Spend.
More spending and more debt. He thinks debt is very good. And of course, Austrian economists say that savings are very good. People should work hard, not spend all their money, save their money, invest either in their own business or loan it to somebody else. But the Keynesians don't believe that. They think you can have perpetual growth by spending money, running up debt, and propping things up. So in 08 and 09, the Austrians were arguing the case that they knew about it. It was coming, and they argued, keep your hands off and let it go down like it did in 1921. But no, that didn't happen. And so the bubble was leaking, and it went down some, but as the chart shows, it immediately resumed. But now things are so different. The Fed has so few tools. You know, back then the interest rates were like 6%, and they had all we'll cut interest rates. Cutting interest rates and printing money has always been the solution. Today, under these circumstances that were rather rocky, I noticed that the dollar was down 1.5% almost, which is huge for the dollar. So the dollar is not sacred either, and that'll be interesting. Gold did not crash as it did in 08. It still, could have some corrections and all, but ultimately, as people realize of how much money printing there is and how much debt accumulation is, they're going to have to look for something that they can hang on to. For instance, the debt for the United States in 2008 was, what was it, around
Around $10 trillion.
$10 trillion, and now it's $18 trillion. And that's a huge jump. But what about in China? In that period of time, it was $7 trillion now. Now it's $28 trillion. So if debt is good, China shouldn't have any problems. We just keep doing it. But I wonder how many people were proposing when Zimbabwe's currency went down. They say, well, what they need is just more debt, and they need to print more money. Well, they ran out of room to printing their zeros. So the whole thing is a fallacy. But the problem why the predictions don't work is because there's more than just a computer that makes these calculations. We have been printing money a lot and the debt is out of control, and smart people were very skeptical. Austrians predict the bubbles. And I had 3 different Federal Reserve Board chairmen tell me that you can't predict bubbles. And the only time you know there's a bubble is when it collapses, when it bursts. Then there was a bubble. And they wait until this happens. So you only have to wait and see it. So if you look at 1929, look how that gigantic jump in the stock market. Well, I'm sure there were plenty of people that knew there was a bubble there. So there's a lot of emotions in it, but you can predict bubbles. You can't predict the day it's going to burst. Mm-hmm. And you can't predict today exactly where the market's going to go. If it corrects and it goes up 1,000 points tomorrow, that doesn't contradict Austrian economics, because first, markets can move because of the emotions of the investors, but it also can move because we have this additional factor of unlimited supplies of money and regulations that can buy and sell. So today you mentioned that there was a sudden jump in the stock market. You wonder, well, what did the Fed do? Oh, we'll check the minutes. They're not going to tell us. They might have increased the credit to some of their friends overseas, and some buyer comes in and decides that, we need to prop this up because we're all in this together. We can't let the dollar go, and we can't let, it's bad enough China's in trouble. What happens if the United States gets in trouble, and what happens if the dollar gets into trouble? Well, it's going to be. The big thing is you won't be able to predict it, but economic growth is not there. Most people in this country now recognize this by the measurement of the middle class, and this is what's going on in the presidential campaigns. Everybody knows the middle class is suffering. So whether you have a Bernie Sanders or a Trump, they argue the same case. We're going to cut down on Wall Street, and even Trump's talking like this. There's an article today that showed that a lot of Trump's statements are similar to Bernie Sanders. Of course, I argue that they're both authoritarians. Trump is his own authoritarian. I will take care of it. I know what's right, and I can make America great. And even though you don't have the vaguest idea what he might do, Bernie Sanders is a little more upfront and honest. He believes in socialism. He believes in forcibly redistributing wealth. So I haven't heard them too much say you get rid of the Fed. Bernie, you give him credit because he did want to know more about the Fed and has given us some support on auditing the Fed because he understands that the Fed does prop up his enemies on Wall Street. But this could all be solved with sound money, get out of the business of regulating interest rates, get out of the business of interfering with market forces. This would be solved. But this is not the end. No matter what it ends up today, even if it's up 500 points after going down 1,000, this is not the end because it may be just a temporary reprieve by investors. It may be the Plunge Protection Team, but there's so much gross distortion with debt and malinvestment and unemployment, structural unemployment. The workforce is so much smaller now than it has ever been. So that's where the real problem is, and it's so different. I think it's much worse than 08 and 09. If you listen to the pundits on business stations, they say, "Oh, things are so much better today. We have control of things." So, are you a big investor? Have you been trading stocks today, Daniel?
I collect my pennies and buy a little silver.
Silver, there you go. That's not too bad idea. That's interesting about silver. Gold has held its own and it's gone up. It's been up $60 in the last month, and that to me is significant when things have been going down. But silver hasn't done it, and usually they move together. So you wonder what's happening. Maybe somebody's selling silver to keep prices down artificially low so there's no contagion with people automatically buying gold. Or people are looking at silver as more as a commodity than as money, which they can do depending on the circumstances. I believe it's money and ultimately will respond and do what gold does. But gold, I think you have to have a commodity as money, but it has to be a precious commodity, and people want to, it has to be a universal thing, and it can be used in industry or in jewelry or whatever. And silver is an industrial metal, but for the moment, silver's not going up. So I think your suggestion might not be a bad suggestion. It's, buy silver coin, buy a silver ounce, or as many you can, because certainly silver is going to be a lot better hedge long term than it will be to hold Federal Reserve notes. What do you want, a stack of Federal Reserve notes this big, or a stack of silver that same size? Well, I would go with the silver, and I would go with the gold. But nothing is going to be solved with this problem until we get a handle on the monetary system. The dollar will finally collapse. There will be monetary reform. We have to have enough people to realize that Fed is a useless organization. They cause much more harm than good, and that it subsidizes the growth of government. It subsidizes wars. It is a perpetual threat to our liberties. So not only must we get rid of the Federal Reserve, we have to get rid of management of money and management of the economy, have more trust in liberty and property rights. That will solve these problems. But in the meantime, in spite of the fact that the politicians could do it immediately, allow the correction as necessary, let the liquidation and the deflation occur, which is what the market is trying to do. That's not going to happen. They're going to prop up until the dollar is destroyed. And maybe we're seeing signs of that already, the dollar being undermined. At the same time, the Fed is very, very much involved in trying to settle this market. But time will tell. My prediction is that conditions will not be a lot better in 3 months or 6 months, because they will not have offered the real solution, and the conditions could very well deteriorate over this period of time. And it'll be interesting to see what happens in the presidential election, because everybody wants to help the middle class, including myself. The big job is to explain why the middle class is getting wiped out. And if you really want to know, go study the Federal Reserve, because they are the culprits who cause the most damage to the middle class. I want to thank everybody for tuning in today to the Liberty Report, and please come back soon.